I really want to focus on who's a sponsor, what's their track record, how many deals they entered and exit, and did those deals work out the way that they modeled them, right? And that's the biggest thing. Like, you're putting together a pro forma. How did it work out, right? I mean, things don't always work out exactly like you say in your pro forma, but that's the biggest deal, right? What was the execution of these deals, and did it work out to kind of the way we're pitching as an investment to somebody else?
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Jake Clopton is the president of Clopton Capital. They are a nationwide commercial real estate finance company. They arrange debt and JV equity for all commercial real estate asset types. Jake, welcome to the show.
Thanks so much for having me on.
Hey, man, pleasure's mine. Same 3 questions I ask every guest who comes on the show in 90 seconds or less. Can you tell me, where did you start? Where are you now? And how did you get there?
Okay, got it. So before I started this company, I traded interbank hedging futures, like 3-month LIBOR futures and Fed funds and stuff. And I quit doing that around the 2009 era. It's pretty obvious what happened then. Interest rates went to zero. And, if you trade things, they need to move around. And that just wasn't happening anymore. So at the time, right, there was, a huge crunch to find business capital. So my idea was to move into finding a way to insert myself, into the mix of being able to find capital for people, right? So we did, right? We're an intermediary. We connect sponsors with capital sources, right? And I didn't have a background in the business, really. Candidly, I just started making phone calls and calling people and calling banks and trying to find lenders, this and that, and putting it out there that what we were doing. And 14 years later, man, I mean, this, it's working out pretty well. So.
That's really intriguing. I want to hear more about that. Like, you just start calling banks randomly. I mean, there's got to be more to it than just throwing mud against the wall and seeing what sticks.
No, yeah, certainly. I mean, whenever we started something new, right? I mean, I didn't know, maybe I guess I'd say all the lingo and exactly, who to get through to. But one thing I'm pretty good at is cold calling people. I have absolutely no problem with it. And I'll stalk them down like I'm their ex-girlfriend. So I just really started, calling banks and lenders and networking. And honestly, it was really the networking, right? Like asking people to, connect me with people and like going all, hitting up social media and researching people and really, after you kind of, envelop yourself and then make it your life for a couple of years, it catches on pretty quick. We made a lot of mistakes, right? But that's how a new business starts, right? And once you hit that critical mass of screwing up so many times, you start to do things right.
Yeah, that's intriguing. So the hole you saw in the market, of course, was that there was no money available. And then you saw that there were people that needed money. And you said
it was a financial crisis, right? I mean, that was the difference between 2009 and 2020, right? 2009 was a financial crisis, like their bank balance sheets, right? There was no lending. That was the issue. 2020, the markets were healthy the entire time. There was lending available, and that was never the problem. And that's one of the reasons why you've seen such an enormously fast recovery, right? I mean, there was all these social programs and stimulus as well, right? But I mean, the fact that the capital markets were healthy the entire time, I mean, that really is what springboarded it forward.
Right. Yeah, absolutely. That's really, really intriguing. So, I mean, out of the gate, you had to have at least a handful of people saying, "Hey, I need money." And then you had to have at least a handful of people saying, "Hey, I need to lend money." How did you put those two together? And then how do you guys make money on that putting those two together?
Right. I mean, so, what we do today is, I reach out to people that, we think would be good sponsors to work with, right? So people that are doing real estate deals, either syndicators or private investors or small to middle market real estate companies, right? So we finance in like the small to middle market space, which I kind of say is like 1 to 100 million. Although with inflation, I feel like middle market's getting higher than that, right? So, we actively go out and talk to people and network. I mean, I've been doing this for 14 years now. So, I mean, at this point, people are just kind of finding us in different ways, right? And then, the same thing for the capital market side, right? It's, I wouldn't say every intermediary or broker out there has the same relationships in the capital markets. I mean, candidly, I think, certain guys get great relationships with, lenders, and they're able to do things that other guys aren't because of that relation. I mean, at the end of the day, on both sides, it's really still people making decisions. Right. And if you've got a great relationship with one side that you can kind of push a deal through, or, it's like, hey, this is really something you guys need to look at. I think this, this would be a good deal to finance. I mean, that definitely, carries weight.
Yeah, that's really, really intriguing. Now, what you guys are doing is different. What we typically talk about or see a lot in the market right now is, a GP-LP structure where, I'll be the general partner, and then we'll bring in a bunch of private investors, maybe 20 investors. They'll put their money in. They're the limited partners in the deal. You guys are doing something entirely different than that by calling it JV limited partnership money. Does that mean you guys are bringing all of the money? Does it mean you're bringing 90% of it? What's that mean? And then how are those deals structured?
Yeah. So the real difference is, one is a real estate security that's highly regulated and one is not, right? And the one that's highly regulated is the passive investors that don't really have a say in what's going on, right? So joint venture partners, right? I mean, the first thing that's going to stick out to you is there's going to be a joint venture agreement, right? They have controls. They can make decisions. They can force a sale, stuff like that. Just because of the limited partner doesn't necessarily mean it's going either direction, but it's more about the actual joint venture aspect of it. If you're doing passive investing, that's a real estate security. And, you've got a lot of rules that you need to adhere to, right? Typically going through a broker dealer, doing PPM, stuff like that. So as soon as you see certain things like a PPM, reg the offering, if you're, stuff like that, you immediately know, right? It's a security type deal. And candidly, that's where I've seen some sponsors, kind of, get themselves or possibly in the future a little bit of like heat because, if you're structuring stuff as passive investments, and you're not structuring it the right way and going through the right channels in structuring real estate security, if something happens, you might end up getting a phone call about that later on in the future, right? So something to keep in mind for sponsors that are raising equity like that.
Oh, for sure, for sure. Lots and lots of landmines. Tell me about the structure. I mean, one of the things you just pointed out, one of the interesting nuances is that you guys have a controlling interest in the deal. So what are some other kind of differences between the ordinary syndication model and then the JV limited partner model?
Yeah. So if you're doing a syndication, right? So one of your, the people watching the show is investing with a syndicator. They're most likely, right, one of, I don't know, depends on how big the raise is, but maybe one of 50 people or something like that, $50,000 at a pop, right? In a JV scenario, typically that will raise, there's really one investor. And I think on both sides, on the GP-LP, you typically do a 90-10, right? 90% of the equity is the LP partner, and then 10% is going to be the GP. But the biggest, difference as far as structure is Syndicate has got all these smaller individuals, that are just investing capital and they don't have really a say. They're just along for the ride. Whereas with JV, you've got one investor primarily. It could be, a fund or maybe like a family office or something like that. They typically want to be the single LP investor. I mean, even getting as high as like 20, 30, 40 million bucks, as an equity check. And then, that's going to be the biggest difference. And then they are going to have controls. For instance, most of the JV deals we do are shorter term in nature, like value adds or construction, with a 3 to 5 year timeline, right?
Right.
So if they can't recycle their capital kind of in that timeline, they can potentially force a sale and stuff like that. I mean, as an investor in a syndication, again, you're just along for the ride. You can't do that. Unless the only way you're getting out ahead of time is if you sell your position to somebody else. And I'm guessing you're doing it at a loss if you do that. So
right. Yeah, that's you bring up a good point there. Yeah, that you could sell your position, and maybe it's not even at a loss, but it certainly is a hassle. And,
yeah. Oh, for sure.
Yeah, fine. And I'm going to take a left turn here since we're talking about it. I think it's interesting the idea of blockchain real estate coming, which will bring some potential liquidity to that. I don't know if you've studied that at all, but the ability to sub out investors quickly and easily is, I think, on the horizon.
Yeah, I mean, I think it's got a long way to go. I mean, you could do it today, right? And the whole value proposition of it is that there would be this liquid market with a bid and an ask, right?
Right.
Where if you're like, hey, got to get out, let's go to the market. We'll hit the bids, and then we'll sell it.
And that assumes anybody knows anything about, if I'm putting a deal together and you put it out in the open market, no one's going to know who Brick and Investment Group is. I'm really sorry, but I mean, the vast majority of the United States would be like, who's that? What do they do again? Like, we have less than 100 investors. Okay. That's really nobody. So yeah, that's really intriguing. Sorry to go down that rabbit hole, but I just thought it was an interesting point you made there. Talk to me about so you guys bring 90% of the deal. I mean, what's your percentage of ownership in it?
So every deal is a little different, right? So, I mean, it's really a joint venture as far as ownership. So, the way we model it more is based on like what the returns of the LP investors are,
right?
Ultimately that they're looking for. And typically, what the returns they're going to get are somewhere, it depends on the deal, but I'd say the average is high teens and then like a 2.0 equity multiple, minimum. So that's really what these guys are going to be looking for the most part. I mean, the returns in general are heavily weighted towards the general partners, but it's different for every deal. And general partners, depending on what they're bringing to the table, command more ability and more leverage, right, to get a better return. Like for instance, let's say I bring a general partner to the table. They found a deal on LoopNet, and they're using a third-party management company as a property in Texas, and the guy's in, I don't know, New York or something, right? That's maybe a deal the guy doesn't have an enormous amount of leverage in, right? I mean, it's basically all third party managed, founded on LoopNet is out there. The LP probably saw the deal, right?
Right.
Big difference between a guy, an operation that's vertically integrated, meaning, they went out, they originated the opportunity themselves. That's the only way somebody has access to it. Right, wasn't really on the market. They also do their own management, their own contracting work and everything like that. I mean, that's a deal that those guys are going to have a lot more leverage to get better returns for themselves versus, the former.
Yeah, absolutely. So, it's a joint venture deal. When it comes to fees and things like that, I mean, again, going back to the typical GP LP structure and just kind of doing a cross comparison of these two. One of the ways that sponsors get paid is obviously on acquisition fees.
Right.
For us, that's all we charge, an acquisition fee, and then we're done. There's never a fee again in the deal other than maybe an asset management fee. You guys cut those out and say, okay, look, we're bringing 90% of the capital. There's no acquisition fees. And this is, does it get pretty lean on that front?
No, there is a level of market fees, right? That, we can get in any deal. And, typically, what the things that they're going to be very focused on is how much capital do the GPs actually have left in the deal after you extract out the fees.
Right.
And that's really the biggest concern, right? I mean, I don't really care that some GP is, getting a point or two at closing, but what I really care about is that they still have like actual skin in the game post that. And, and so it's like some of the deals, we see that, are really hyper packed in fees, like a 4% acquisition fee plus a 2% asset management fee plus a construction fee and this and that. And then, they're also using third party management and all this, you know what I mean? Like I've seen it get really built up, and I'm like, I don't know, man, it feels like I'm just financing a job for you, to be honest, but yeah, I mean, I would say, market acquisition fees, 1.5%, it's up to 2%. If they're going to be doing the management themselves, sure, management fees, great, right? But it depends also, bringing up what I said before is access to the deal and how it was originated. I mean, for instance, if the guys originate it completely themselves, and there's no real estate brokers and it's just a unique deal to them, no one's access to it, maybe they get a bigger acquisition fee out of that, right?
Right. That's really, really intriguing. So, I mean, I love everything you're breaking down here for us. Thank you for that. Talk to me about the credentials of the sponsor. Like when you guys look at, because I know that's probably one of the biggest things you look at, you need somebody, I'm certain, with a track record that knows what the heck they're doing. But by the time you get somebody with a track record that knows what the heck we're doing, have they not crossed that threshold where they don't need a 90% JV equity partner anymore?
No, actually, I would say it's probably the opposite, right? So a lot of the guys that we end up working with, they're going into like the more institutional equity space, are
Mm.
actually making the jump from doing deals themselves using like, private investors like friends and family money or a small pool of private investors. And they want to, scale. They want to leverage out even more, right? And so what do you need to do that? You need better access to equity capital, right? And so once you move into, I mean, just think about it, like as far as like an operational perspective, like let's say you were doing 3 deals and you have 20 investors in each one of those 3 deals, right? I mean, the reporting alone to all 60 investors, I mean, that's a lot. So if you want to scale out to 10, 12 deals you have, and each one of those is 20 investors or 30, I mean, think about it. I mean, just the internal reporting, extremely cumbersome. It makes a lot more sense to kind of go to, a little bit larger sources where there's like one big pool of capital that you can do successive deals with. And obviously you're dealing with one investor instead of 20 on every deal, right? The guys that want to scale, they're typically going to keep their equity, kind of reserved for GP equity. I mean, the GP equity returns are, if you leverage that with LP, significantly higher, right, than just the LP is getting, or what you get without it. So, that's the whole thing. You want to keep those 30, 40% returns going, leverage that into more deals, and, also kind of have the bandwidth to manage that. And realistically, you're going to, you're going to want to move into more of an institutional style, LP. And I don't mean BlackRock, right? I mean like, small to middle market funds, maybe family office, but, the guys that we like to use the most are, and I care about the structure of the money that we're bringing to the table. I like to use funds, right? So capital that's raised around a strategy that's being deployed for the specific purpose of investing alongside GPs.
Right.
When you start getting the private investor and family office space, you kind of get a little schizophrenia, there. And it's like, they're involved in lots of stuff and they don't have to put their money out. And the stock market goes down 10%. They're like, well, we can't fund the deal now because we got to wait. You know what I mean? So, I mean, those things happen for sure. You don't want to get left, get stood up, at the closing table because, whatever, the Dow took a dive the day before. So.
That's really, really intriguing. That's not something I would have thought of, but I guess that is always a risk there when you have someone bringing the lion's share of the money. Is that
exactly.
They could, I mean, until that check is cashed, they can walk. Have you seen that
Right.
happen, and how do you avoid that if so?
I've never had it happen to me because I target the capital that's earmarked directly for this, right, for our sponsors, and that matters, right? I mean, the thing is, if you've got a family office, or a private investor, and they're big investors, you may be going along just fine, but then, eventually you're going to run that risk, either them running out of, because you don't really have clarity in what's going on that side. Right. And something may happen in the future. And I've seen that happen to people. Right. I mean, I've had people call me up. Hey, man, I'm supposed to close next week. My equity guy just called me up, said, can't do it. So I was like, well, do you have a commitment? He's like, yeah, we have a commitment letter, but that doesn't matter now. I got to close this deal. Right. So,
right.
I mean, it happens. And I'm sure somebody listening right now has had it happen to them.
Oh, man, that would be, talk about scramble. And
oh, yeah. Yeah. That's not that's not one of the reasons you want to have to go back to the seller to tell them that you don't have the down payment money, right?
No, that doesn't always go over so well. Tell me about, give some good or some good best industry practices. If somebody wants to take their business to the next level, they want to bring on some JV limited partnership money, somebody's writing one big check. What are things they need to be doing now to prepare themselves for the conversation with you and for your potential investors?
Right. So the guys that we use, really what they're looking for is, outside of the specific deal they're going to invest in, a sponsor with a track record, right? And you really just need to prove out that you've been able to do this a couple of times. And the guys that come to us are breaking into the space have used private investors, in smaller deals, and you ramp up to the size, that's going to attract these, institutional investors. And the institutional guys are going to have a minimum equity check size of really like a bare minimum of like $3 million, right? So you've got to have a decent sized project to be able to get them in there. So really, if I see like a $15 million capitalization deal, that's probably like a good starting point for institutional, investors. But and I've seen, syndicators and sponsors just, work their way up quickly to get up into that space. And then once you're there, you're going to kind of play around in the 15 to 35 maybe space for most of the time, because you're flying under that institutional radar where the returns just kind of drop off a cliff, right?
Right.
And so, realistically, when I put together like a package to send to, one of our, JV guys, I really want to focus on who's a sponsor, what's their track record, how many deals they entered and exit, and did those deals work out the way that they modeled them, right? And that's the biggest thing. Like, you're putting together a pro forma. How did it work out, right? I mean, things don't always work out exactly like you say your pro forma, but that's the biggest deal, right? What was the execution of these deals, and did it work out to kind of the way we're pitching as an investment to somebody else?
Right, man. I love that. I love that. Jake, thanks for taking the time to break down really the differences and the nuances between JV limited partnerships and a lot of what we see in the securities, syndication space. That's been absolutely intriguing. If our listeners want to get in touch with you, learn more about you or your business, what is the best way to do that?
2 easy ways. Either hit me up on LinkedIn, it's been really easy to find, or our website, cloptoncapital.com. Call us directly. We're around anytime.
And that's Clopton, Clopton, capital.com for those of you who are listening. Jake, thanks again for your time today. Certainly appreciate it.
Thanks, man. Take care. Thanks so much.